Hey there, fellow investors. Today, we're diving into the world of investment mistakes, and who better to learn from than the Oracle of Omaha himself, Warren Buffett? Grab your favorite beverage, settle in, and let's explore 10 investment pitfalls you'll want to avoid like the plague. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. 1. Trying to dance with the market. Picture this: you're at a dance, and the DJ is the stock market. You think you can predict every beat, every drop, and every rhythm change. Spoiler alert, you can't, and neither can anyone else consistently. Buffett says, "Charlie and I don't think about the market. We look at individual businesses." It's tempting to try and time the market, isn't it? We all want to buy low and sell high. But even the maestro himself, Benjamin Graham, Buffett's mentor, occasionally fell into this trap. Instead of trying to predict the unpredictable, focus on what Buffett calls the important and the knowable. Identify great companies at fair prices. Pick the best dancers at the party, they'll shine regardless of the DJ's playlist. 2. Getting stuck on your purchase price. Imagine you bought a stock for $100, and now it's worth $50. You feel terrible, right? Now flip the script: you bought at $10, and it's now $50. You're on cloud 9. But here's Buffett's million-dollar insight: all these feelings, and it has no impact whatsoever. The stock doesn't care what you paid for it. What matters is the company's future prospects, not your emotional attachment to a number. So, next time you're agonizing over your entry price, remember, the stock market isn't a therapist. It's not there to validate your feelings or soothe your ego. It's there to reflect the value of businesses. 3. Falling for aggressive projections. I think it's a mistake for any company to predict 15% a year growth, Buffett warns. Yet, how many times have we seen companies or analysts throwing around these pie-in-the-sky growth numbers? It's like promising your parents you'll clean your room every day for the next year. Sounds great in theory, but let's be real, it's probably not happening. Very few large companies can consistently grow at 15% annually. It's not impossible, but it's about as rare as finding a unicorn in your backyard. Don't base your investment decisions on fairy tales and wishful thinking. 4. Borrowing your way to trouble. Buffett puts it bluntly: really, the only way a smart person can get in trouble is through leverage. Investing with borrowed money is like playing Russian roulette with your financial future. Sure, it might work out a few times, but eventually, you're going to blow a hole in your portfolio. Keep in mind that when you use leverage, you're not only betting on being correct, but also on being correct within a certain time. The market can act irrationally for longer than you can afford to stay in the game. Don't let impatience turn into imprudence. 5. Missing the forest for the trees. Ever spent hours poring over every little detail of a company's financials, only to miss the big picture? Buffett's been there, done that, and has a t-shirt to prove it. He says, "We've made plenty of mistakes in acquisitions. But the mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company." Focus on the 3 big things: the price, the management, and the future economics of the business and industry. Get these right, and you don't need to worry about every little detail. 6. Jumping over 7-foot bars. Buffett and his partner Charlie Munger prefer to multiply by 3 than by pi. In other words, they like to keep things simple. But why is simplicity so crucial in investing? Let's dive deeper into this Buffett wisdom. Imagine you're at a track and field event. You see 2 high jump bars set up, one at 3 feet and another at 7 feet. Which one would you choose to jump over? Unless you're a world-class athlete, you'd probably go for the 3-foot bar, right? In the investment world, you get the same medal whether you clear the 3-foot bar or the 7-foot bar. The most successful investors, including Buffett, often have the simplest strategies. They focus on understanding businesses, buying at good prices, and holding for the long term. No calculus required. Let's look at a real-world example. Remember long-term capital management, LTCM? This hedge fund was run by finance professors and even Nobel Prize winners. They used highly complex mathematical models to guide their investments. Sounds impressive, right? Well, in 1998, LTCM spectacularly collapsed, nearly taking the global financial system with it. On the flip side, consider Buffett's investment in Coca-Cola. His thesis was simple: Coca-Cola is a strong brand that people like, it's affordable, and it's sold worldwide. Therefore, it's likely to be profitable for a long time. No complex models, no advanced mathematics, just straightforward logic. 7. Shrinking your universe. Buffett believes it's a mistake to limit your investment universe unnecessarily. It's like going fishing but deciding you'll only cast your line in one small corner of the lake. Sure, you might catch something, but you're missing out on all the big fish in the rest of the water. Keep an open mind. Opportunities don't conform to neat categories or sectors. They pop up in unexpected places. Be ready to cast a wide net, but always stay within your circle of competence. 8. Staying active all the time. If you feel you have to invest every day, you're going to make a lot of mistakes, Buffett warns. Investing isn't like exercising, more activity doesn't necessarily lead to better results. Think of investing like baseball. You don't have to swing at every pitch. Wait for your fat pitch, that perfect opportunity that aligns with your strategy and knowledge. Patience isn't just a virtue in investing, it's a superpower. 9. Spreading yourself too thin. Here's a Buffett bombshell for you: if you really know businesses, you probably shouldn't own more than 6 of them. Shocked? Many people are. We're often told that diversification is the holy grail of investing. But Buffett argues that over-diversification can dilute your returns. Think about it: are you really going to find 30 amazing investment opportunities? Or are you more likely to have a handful of great ideas and a bunch of mediocre ones? Focus on your best ideas. As Buffett says, very few people have gotten rich on their 7th best idea. 10. Seeing what you want to see. We humans have a talent for interpreting new information in a way that confirms our existing beliefs. It's like having a reality filter that only lets in what we want to see. Buffett admits, Charlie and I have made big mistakes because, in effect, we have been unwilling to look afresh at something. To combat this, try the bear pill approach. Before investing, intentionally seek out potential pitfalls. Play devil's advocate with yourself. It might feel uncomfortable, but it's a lot less painful than losing money because you were wearing rose-colored glasses. The costly sin of omission. Before we go, let's touch on what Buffett considers his biggest mistake: the sin of omission. These are the opportunities you knew about but didn't act on. The slam dunks you watched from the bench. Buffett estimates he's cost Berkshire Hathaway billions by sucking his thumb on great opportunities. So, when you find that golden opportunity within your circle of competence, don't just stand there, take action. Remember, in investing, as in life, it's often the things we don't do that we regret the most. So there you have it, folks, 10 investment mistakes to avoid, straight from the wisdom of Warren Buffett. Keep these in mind, and you'll be well on your way to smarter, more successful investing. Until next time, happy investing, and may your portfolio always be in the green.